Hey guys, Stock Saturday, and it's a bit of a unusual week. Been very volatile, and a huge amount of change going on in the portfolio. I'm up about 1.5%, about 24,000. As I say, it's been a pretty rocky up and down week. It was a sort of 150,000 up, I think, at one point. And yeah, we've had a bit of gold and silver sort of turmoil on Friday after sort of just record highs every day, and crypto market sort of been very, very unhappy at the moment. But yeah, I sort of have been making some sales, which we'll come back to. But yeah, so up 1.5%. Nasdaq is up 0.78%. So pretty happy with that. And the S&P up 0.53%. So pretty good. Expect my portfolio will start to more resemble the stock market as I sort of buy more and more ordinary stocks and get out of sort of the crypto and maybe not so much the gold and silver side, but certainly the crypto side being, including the actual crypto itself, like 70% of my portfolio or something, which was never going to be forever and ever, of course. But yeah, I am sort of buying an awful lot of ETFs, you may notice. So the plan was always, after, the post sort of crypto portfolio would be largely stocks and ETFs. And I sort of thought in a approximately 60-40 split, 60% individual stocks and sort of 40% ETFs of the sort of stock side. Then have maybe some gold and silver, and maybe keep some some real crypto, not the miners, sort of just some Bitcoin, and small allocation sort of for a bit of diversification. But of the stock side itself, 40% ETFs. So I thought I would go through what I had picked. I had shown what I was somewhat planning to buy in previous videos, but yeah, there's been sort of a few changes as I've started to think of things, and sort of it's quite awkward buying these both in ISAs and in Trading212 invest account, because sort of remembering that looking at various ETFs, I don't want distributing ETFs to go in the invest account, because that's sorry, I don't want accumulating ETFs to go in the invest account, because it's makes it very awkward for taxes and things. You don't actually get paid the dividend. You have to sort of try and report the dividend that has been reinvested back into the fund, and that's just a little bit harder to get at, and yeah, didn't really sort of seem worth it, even if I am using an accountant. But yes, so one of the largest allocations that I was going to have, or am having at the moment, is a Nasdaq 100 ETF. So part of the reason for not going with an S&P was that I have very little sort of tech exposure, and I'm not that keen on sort of individually buying your Nvidias and you know Googles and people like that, and especially sort of Tesla. Obviously, Tesla will be in there. Um, but obviously, I'm buying exactly the same stocks in a Nasdaq 100 ETF. But I don't know, it just sort of abstracts a little bit of that away from my mind. But yeah, so sort of the S&P 500, I kind of think I've got a lot of individual sort of general US stocks that would be in the S&P 500, and Nasdaq obviously very heavily weighted towards tech. So I actually have a split, some in the ISA of this X-Trackers Nasdaq 100 ETF. A lot of people sort of go for the QQQ one, which the Invesco EQQQ or iShares Nasdaq 100. They're both 0.3% expense ratio, which just sort of seems a little bit expensive compared to sort of your S&P 500s are like 0.07%. Not quite sure why it's so expensive to invest in Nasdaq 100, considering they are sort of, over 50% of it is Mag 7 companies with huge liquidity and everything. So, yeah, it just seemed a little bit awkward. So, that seemed quite low expense ratio. I wasn't aware some of these were available lower than that, but it is an accumulating one. So I wanted a distributing one for the invest account, and found this UBS Nasdaq 100 distributing fund. Now it's 0.13% expense ratio, but it's only got £5 million in fee, and so I've sort of gone with that on the basis that UBS are, a very, very large bank. They were part of the merger, I believe, last year in sort of, or 2023, in the crisis with sort of Credit Suisse and all of them. But I would still think too big to fail, and they're not going to be doing sort of anything particularly funny with this ETF. I mean, if it's too small and it sort of doesn't grow and ends up closing down, I'm presuming that I would just get paid out the cash and have to buy another one basically. But yeah, sort of kind of thinking if they're the cheapest now, maybe people will spot this and it'll grow in funds. It didn't seem to be a huge spread on buying it either, with sort of being a low liquidity fund. So at the moment, I think I'm going to sort of go lean more to that. Looking at it, obviously, your main holdings are, basically Mag 7 and the like. Tesla, 2.8%. Don't really want that in there, but is what it is. Nearly 10% Nvidia. Yeah, as I say, I don't feel sort of strong conviction to sort of buy it here. I had the 3x short way back for people that sort of remember that appalling mistake. But yeah, so I thought, give myself some tech, and don't have the S&P 500. So then, wanting a little bit more diversification, and sort of, as I say, not particularly wanting to go for S&P 500, I thought go for the mid caps and small caps. I'd sort of shown these on my wish list, if you like, ETF plan, and yeah, they're both 0.3% expense ratio, which is kind of annoying considering they are sort of still, fairly big companies, especially in the 400. A lot of these are sort of 10, $15 billion companies. Should be fairly cheap to buy. There's only 400 holdings in these, obviously being the 400, and the small cap 600 being 600 companies after the 400. So it goes the 500, 400, and then the 600. I think you can buy an S&P 1500, which contains all of them. But obviously that's heavily weighted towards Mag 7 again. But yeah, kind of like the the splits on some of these. You come down to sort of holdings. They're largely sort of small allocations. The top holding is 0.9%. Presumably because if you get too big in this, then you join the S&P 500. So it's sort of quite diversified. It's not an equal weight, of course, but the largest one being less than 1% is quite nice, and 6.8% in the top 10. Where sort of the Nasdaq, you've got Nvidia as more than that just for one holding. So that's pretty good. It's all United States pretty much, other than some sort of jurisdiction issues, and quite a interesting sector breakdown as well. I'm sort of liking industrials at the moment, and industrials is the top category. Financials, don't really hold a lot of them traditionally, so you get some banks and things in there. Technology only 13%, consumer discretionary 12.75%. So that was pretty nice. You can see sort of healthcare, real estate, or your other general sectors. So yeah, that seemed quite a nice holding. And the S&P 600 is somewhat similar. Financials and industrials at the top, consumer discretionary, and these are It's a little bit different to holding the Russell 2000. Some people might say, why not hold a Russell 2000 for the small cap? The S&P 600 sort of screens out some more of the unprofitable companies that might be in the Russell 2000. You're sort of a little bit more hoops you have to get through to get into the small cap 600. So you might say those are sort of the growing companies that you want. They may not be profitable yet, but they're going to be in the future. You know, your sort of tech companies of today, a lot of tech companies would have been unprofitable tech at some point in the Russell 2000 maybe, but yeah, I'm sort of happy to catch them once they're sort of go profitable and, you know, on the way up, let's say. Similar sort of percentages to the 400 as well, largest holding 1.12%. You know, never heard of any of them, of course, which is kind of a good thing, I suppose, because they are, you know, very, very small. Oh, and yeah, even though they are distributing similar to the S&P these days, it's a very small yield, 1.27%. So, yeah, that is rather small. Not interested particularly in the dividend itself. Just as I say, wanted distributing to avoid sort of tax issues. I haven't actually found a S&P 400 distributing ECF, so sort of haven't maybe buy more of this in the ISA and less of the others, just because I can't buy it in the invest. So sort of weighing up overall basically and not buying even in both accounts. So might look a little bit funky in the portfolio going forward, but needs must. So I did own this years ago. iShares Global Clean Energy. It's a sort of rather unpopular ETF in the forum in the Discord because it's not performed particularly well. Sort of topped out in 2021 when everyone was getting really excited about clean energy stocks, and yeah, 0.65% expense ratio. So that doesn't exactly help things when when the price is on a downturn. And yeah, you're sort of just getting this for 2 years and getting charged 0.65%. Well, it's included in there, but yeah, getting charged that on the way down, it's not particularly nice. But I do think clean energy is going to be required partly for all of the data center power and everything that is needed. So that was sort of part of the reason behind the next era energy buy. It's sort of put forward as the quickest way to quickly scale up power, even quicker than natural gas and considerably quicker than nuclear. So yeah, I was sort of looking at one or two of these individually. First Solar in particular, they've kind of got away from me a little bit, and yeah, I didn't really want to sort of buy them individually anymore. But again, sort of being the top allocation in an ETF isn't the worst thing, and then you get a load of others, of course, tied to sort of wind and solar basically. It's quite top 10 heavy. There's only 99 holdings in the whole ETF, so 50% in the top 10. It's quite diversified, only 23% US, some China in there, which is quite good. A bit of Brazil, Denmark, and Spain as your sort of utility companies and things in here, doing a lot of renewables, of course, and a lot of oil and gas still. Yeah, it's 51.7% utilities, some industrials in there that sort of make some of the kit, and sort of technology, maybe not quite so much, not so much clean energy, but there is some tech and some software and things needed. But yeah, basically it's utilities and sort of components and things of wind turbines and solar power basically. So yeah, quite like this as a small allocation. I think it'll be sort of 2% of that 40 going forward. So another thing that's sort of not really my area, but just can see it being required more and more and more as we go on. Digital security. We've had hacks of the biggest companies in the world, basically, and yeah, hacks sort of in the UK as well. They hit the NHS not so long ago, partly because it sounds like they were using Windows XP still, and that's not exactly secure. But yeah, they've hit some, pretty big companies. You get all manner of spam emails at work and things. Can only imagine this is getting worse and worse with AI because it's sort of easier to do. And yeah, your sort of traditional like Windows Defender on, home PCs and things. People are sort of thinking they need a little bit more, but business more so are having paid for security software, and the sort of big, publicly listed companies need even more than that. So they're sort of going for these very, very large multi-billion-dollar companies in the US. And yeah, quite liked this as a sort of cybersecurity ETF. Not companies I would have any idea about sort of buying individually, so I'm just not even going to take the gamble on theirs. You sort of CrowdStrike, admittedly, aren't even in the top 10 here, but sort of see them as quite popular on the Discord. But yeah, I would really struggle to sort of analyze these companies individually, and would probably say they're a bit expensive. So I thought the ETF was the way to go on that. They're obviously largely US, because a lot of these are sort of tech, US focused. Quite a bit of Japan in there, and Israel and Taiwan. Interesting to see Taiwan in there. And yeah, technology companies, no surprise there. This is a distributing ETF. I didn't see that it gives the dividend yield, but yeah, it'll be pretty small because most of these. Oh yeah, this is accumulating, but I think I have the distributing version. But yeah, it'll be a tiny ETF, tiny dividend, because most of these are non-dividend paying companies. But yeah, it seemed an interesting one to go for. And sort of rounding off my little, core and satellite type, this would be the satellite, if you like. The thematic ETFs, I thought global robotics and automation, sort of kind of going that way a little bit on the some of my individual stocks with Rockwell and AB. But yeah, I thought why not go for some of the others that I might not pick individually. I do think this is sort of going to be a big thing going forward, but I didn't want the sort of general ETFs that are largely just sort of holding Nvidia and AMD and people like that. Obviously we need AI for the robots, but I kind of wanted a sort of picks and shovels bet on the physical side of the robots. So, not just sort of buying Nvidia, because that isn't guaranteed to be paying out if we start making tons and tons of robots. And to be fair, the companies are quite heavy in China, I believe, and this sort of doesn't hold a huge amount of Chinese companies, but it seemed a little bit more focused on the actual sort of robots themselves rather than your sort of Nvidia and the tech and software side of things. So you've got sort of Fanuc and people like that, your sort of Japanese industrial arm companies, sort of fairly old companies now, but I presume they've got the big name and they will be sort of supplying some of the components for the robots. Essentially, whoever succeeds in building them. That's sort of part of my reluctance to invest in companies making the robots, because a lot of people are saying still Tesla are the best bet on the robotics industry, but basically they have to succeed at the sort of AI side and the actual functioning of the robot side for you to make money. Where I sort of think if you're in the components people, then whoever succeeds in theory will be buying components from this lot. So yeah, kind of preferred the legal and general ETF as opposed to the sort of iShares ones that I saw, and other companies' ETFs, because they just sort of, rather than this 2% in various companies, it was again 10% Nvidia and sort of 8% AMD and that sort of thing. It just seems like a Nasdaq 100 ETF basically. So yeah, quite like this. 42% US, not exactly super heavy US. 20% Japan, bit of Germany, Taiwan in there, pretty good, and 44% industrials, which I like. So there you go. This is accumulating, but I hold the distributing version of it, and yeah, 0.8%. That's not particularly good. Actually, saying that, I don't think there is a distributing version of this, so yeah, I'm sort of maybe on the lookout for a different one if I'm to add this to the invest account, because I wouldn't be adding this one. Or just similar to the S&P 400 one, maybe I'll just buy this a bit heavier in the ISA than maybe some of the others. So we'll see. Continuing on my Vanguard Emerging Markets holding that I had, so already had some of this in the invest account. Kind of want this to still be a large part of the portfolio. This can be a large part of the ETF side. So topping up VFEM more and more. This is distributing already, and I see they've lowered the expense ratio, which Vanguard seem to be doing to sort of keep up with some challenger companies, really. Vanguard were sort of obviously one of the original companies to be fighting others on fees and lowering fees across the market, and they've been lagging behind somewhat on their fees towards some of the other providers. So they've started to lower theirs a little bit. So yeah, 0.17%. Quite happy with that as a fee. I didn't really see any more attractive ones. It's distributing. It's a large fund, 2,251 holdings. Very nice. And yeah, admittedly, it is 10% TSMC. So that's part of the reason I sort of haven't been, particularly wanting to buy more TSMC, especially as it's up like 150%, I think. So yeah, there's that. There's obviously quite a bit of China in here. You've got Tencent, Alibaba, Xiaomi, and all sorts. 31% China and 19% Taiwan, half of that being TSMC. And then, yeah, you sort of other BRICS nations, India, Brazil, South Africa, and Saudi Arabia. So quite good. I can see some people's reluctance towards China and maybe going for a emerging markets ex-China if there is one, but yeah, that's not really for me. I don't mind China. And sectors, again, looking pretty good. Financials, technology, consumer discretionary. So yeah, carrying on with emerging markets. And lastly, the iShares World Small Cap. Again, this is accumulating, so I'm going to have to try and find another way around this. May sort of switch entirely, but at the moment I'm sort of buying this one. 0.35% expense ratio, a little bit, a little bit high for a passive, but these are small companies. 3,400 holdings, so there's quite a bit of work to do, I suppose. But yeah, quite like the sort of small caps. Over sort of many decades, they have shown to outperform. Not in the last decade, and a lot of people sort of focus on sort of the last decade and say there's no point in holding them. You might as well just hold the S&P, etc., etc., etc. Don't really agree with that. I think you've got to take a longer view. We could end up with a decade of small caps outperforming, and then people will be going back to them and saying there's no point in holding the Nasdaq or whatever. So yeah, I think some people are just sort of a little bit too short term when looking at passive side and sort of just saying S&P 500 and nothing else. No sort of global stocks or anything. But looking at the holdings, it's very small. Largest position being 0.28%. and 2.18% in the top 10. So quite like this. is 53% US, so getting a reasonable amount of US in there. I would expect there'll be some overlap with the S&P 600, I would have thought, but that's okay as long as you know it's there. You know, some people sort of say you shouldn't have overlap at all, but I think as long as you know it's there, you're aware of it, that's fine. US, so Japan 12%, quite a large sort of holding in there for Japan, considering Japan aren't all that big. Not a huge amount of Europe in here, you note, which is interesting. And then again, very similar sectors across a lot of these ETFs: industrials, financials, consumer discretionary, and sort of tech being quite low. It is really just the S&P and sort of US side that is very tech heavy. So yeah, quite like this as an allocation. So about kind of thinking rough numbers: 12% S&P, 12% Nasdaq, 6% S&P 400 and 600, 2% maybe for each of these sort of thematic ones, and then I think 4% maybe on emerging markets and small caps. So that's kind of the thinking going forward. Not a lot in the way of economic news this week. Just sort of with the US shut down, it's basically very quiet still. The UK numbers sort of looking pretty poor. Unemployment rate up. Claimants for unemployment benefit up 25,000 for September. Not great. Average earnings for August up. So earnings up, but unemployment up. The people that do have a job are doing quite well. And yeah, admittedly, some of the sort of industrial and manufacturing production numbers slightly better than expected, but yeah, nothing to sort of really shout about. And that was pretty much it. CPI numbers from the EU slightly higher than expected, but 2.4% for core CPI and sort of 2.2 for headline is near enough where the rest of the world wants theirs. So yeah, can see they wouldn't be doing a lot. So portfolio wise, this is sort of very much still a work in progress. Sort of buying some of the ETFs, having to maybe think about alternatives for things like the S&P 400. The cash is not exactly a permanent thing. I kind of need, I think, about 200,000 for tax. So at the moment, I can't really see a better place to keep that than Trading212. Sort of considering alternatives because of expecting rates to be coming down, but sort of over the next year and a half, really, or year and 3 months, I need to keep sort of a couple 100,000 there. So I mean, I could sort of exclude it from the spreadsheet because it makes the the charts and things look a little bit squiffy. I'm not sort of cash because I'm super bearish and sort of waiting to buy the dip or anything. I could probably spend about another 60 or 70,000 of this, hopefully into the ETFs, but sort of still, as I say, just weighing up exactly where I want things to be in the sort of invest account and the ISA. But yeah, started buying some of these at least. S&P small cap, sort of 10,000 of that, 20,000 of the Nasdaq 100, and topping up the emerging markets. So yeah, we'll see, and buying more of these in the ISA as well, with what cash I do have in there. To sort of free up some cash, I suppose I could be maybe selling out some of the US holdings and sort of rebuying them in Interactive Brokers, but I suppose then it's maybe having tech holdings in the ISA could get me more of a gain tax free, but I don't know. Obviously I need to invest the cash, and I will be probably selling out of a portion of some of the gold and silver stocks at some point because they are still very, very heavy. I think I sold 500 shares of Coeur Mining this week, sort of at a very, very nice $23, I think it was, and they've all taken a fairly heavy hit down on Friday. Although, it's like Coor above $20 is extremely nice. Fresnillo above £25. They're at a happy place at the moment, even with Friday's drop. And I could see them pushing on, I would have thought. The Interactive Brokers ISA, no changes here. Still sort of looking reasonably good. I think this got to sort of 46 at the highs. My sort of little Hive holding has come down quite a bit, and yeah, KGHM and Pan American both sort of taken a slight pullback, but still looking very good, both at 61% in the green. And then yeah, the Interactive Brokers Invest account is getting very much changed at the moment, sort of selling out of almost all of my iron at, I would say, reasonable prices. It might sort of look as if I timed it perfectly because it's had quite a large drop to sort of the 50s, but sort of have to bear in mind that I was selling in the 50s just last week and sort of in previous weeks. So yeah, hadn't sort of timed that perfectly. Left an awful lot amount, an enormous amount on the table. Of course, selling out some in the 30s and 40s and things. So on the options, that makes hundreds of thousands of pounds worth of money left on the table. But you can't sort of be timing all of this and looking in hindsight and saying, well, if I'd have held it all until today, I would have made this amount. I think that's just a silly way of looking at it. You have to sort of take some profit when things are looking a little bit frothy. And yeah, certainly with options, they expire in January, so there is the possibility that sort of the stock dropped, and as they're options, I don't have the luxury of sort of waiting it out and seeing if things come back again. If they drop on options, they could drop to zero, and then I'm liquidated, and I would have to sort of rebuy, and yeah, just don't want to get into that. A couple of people sort of saying it's madness to be selling, but if you're sort of buying it in the $7 on iron and then up sort of 100, 150, even 200x, I think some of them were up. Yeah, that's a bit different to sort of buying the regular stock at $30 and sort of expecting it to go to $100, $150. But there we go. You'll note I sold out of CleanSpark and Riot entirely. They sort of had a nice run up, have since sort of been quite a bit whacked, and yeah, they're not sort of really doing a huge amount in AI, and the Bitcoin side looks rather awful. So I was taken there, I think, going up in sympathy with iron as a sign to get out. The only sort of little moonshot, I suppose, that I have left on the mining side is Hive, because I sort of thought they were lagging behind the other miners a bit, and if Bitcoin was going to have a strong move into the end of the year, of course these are still January options, so kind of need a strong move into the end of the year, and January, that would still be my, moonshot, if you like. But yeah, selling out of a large amount of the options, basically, and re-putting that money into basically topping up my US holdings and sort of a couple of EU holdings as well in AB and Euronext. So just the stocks that I'm wanting and stocks that I own in the rest of the portfolio are now getting larger allocations, and I am sort of doing an overall portfolio. This is kind of a work in progress, basically, because it seems to be broken. When I sort of reorder the stocks in here by size, the overall portfolio sort of breaks. So I need to fix that, and or find, if I can find a way of fixing that, and sort of have target weights and things. If I want sort of BlackRock to be 3% of the portfolio, I can then see how much of that it would be across the entire portfolio, and sort of whether I'm a bit under or a bit over. But that's sort of longer term, I suppose. But it's something that I now start to need to be thinking about as I've sold out of a great deal of the options, and I'm getting a relatively stock-heavy portfolio at long last. Still 130 of cash in here, which essentially all can be spent, I think, since I've got my tax largely paid for. So yeah, hopefully we'll be buying more of these once I sort of work out what is best to buy for my allocations. And I'm kind of treating Interactive Brokers as my individual stock broker going forward, and will probably use Trading212 as an ETF broker. Sort of, I've been looking at maybe moving brokers, or opening up a third broker, but well, partly because of Trading212 having the FX fee, it does start to rack up. They might be commission free, but yeah, when you start sort of selling, 10,000, 20,000, buying 20,000 of another stock, that FX fee sort of really starts to add up, and Interactive Brokers are cheaper for that sort of value. So yeah, Trading212, obviously zero FX and commission for ETFs. So yeah, I don't really need a third broker, it seems. I'll just use 212 as ETFs and Interactive Brokers largely as individual stocks. So there we go. So a hell of a lot of change. Leave your thoughts in the comments below, how you guys are getting on, and like and subscribe. See you soon.